Hey everyone, and welcome to our explainer. Today, we're diving into a story that just seems wild. A stock that went absolutely bananas in a single day. We're going to break down exactly how something like this can even happen.
Just look at that number, 276%. That's how much TGL stock jumped on December 5th, 2025. Now, we're not talking about a gain over a year or even a month. We're talking about one day. A move this huge, this fast, it makes you ask one simple question.
Right? How on earth does a stock just do that? Is it a revolutionary new drug? A surprise takeover bid from a giant competitor? Or is there something else going on, under the hood? Well, let's pull back the curtain and figure it out.
All right, so let's get into the anatomy of this thing. This wasn't some slow and steady climb. No, this was a sudden, almost violent price explosion that caught pretty much everyone by surprise.
So, on that one day, TGL stock went on an absolute tear, hitting a high of nearly $29 a share. I mean, a move that massive gets noticed. And it was all kicked off by one very specific corporate action.
To really get how this happened, we've got to look at the engine that was driving the whole thing. It's a financial trick called a reverse stock split. And honestly, it's the mechanical key to this entire story.
So, what in the world is a reverse stock split? Okay, imagine you've got a pizza, right? And it's cut into 20 little slices. With a reverse split, the company basically takes those 20 tiny slices and glues them together to make one giant slice. Now, you still have the exact same amount of pizza, but you've got fewer, bigger slices. Companies do this to make their share price look higher and more respectable. And TGL, well, they went big with this. They did a 1-for-20 reverse split. So they took nearly 17 million shares that were out there for trading and squeezed them down to less than 1 million. Think about that. The supply of shares that people could actually buy and sell just evaporated overnight. And here is the crucial part. This creates what the pros call a low float environment. With so few shares available, even a tiny bit of buying pressure can send the price into the stratosphere because there just aren't many people selling. It's like supply and demand on steroids. But look, a mechanical change like that is just a dry powder keg. You still need a spark to actually light it. And that spark is always a story, a compelling narrative that investors can get excited about. And believe me, TGL had one. Let's look at the bull case. Okay, so if you're an investor looking at this, here's the story you're seeing. The company is pivoting into the hottest sectors around, fintech and AI. Check. They just reported a net income of over $1 million, which is a massive turnaround from losing money the year before. Margins are getting way better, and they're talking about cool new products like an OXI Wallet. So you can see the picture taking shape, right? It looks like a classic turnaround story, an old company reinventing itself as this lean, mean, high-growth tech machine. You combine that powerful story with that new super tight share structure, and you've got the recipe for an explosion.
But you know how it is. For every incredible bull story, there's usually a bear case hiding somewhere in the details. To really get what's going on, we have to peel back one more layer and look at the risks.
And that is always the million-dollar question, isn't it? When you see a surge like this, you have to stop and ask, is this thing built on a rock-solid foundation, or is it a house of cards? Okay, let's start with that headline number, that $1.26 million profit. If you actually dig into the financial filings, you find something interesting. It included a one-time, non-cash gain of almost $1.8 million. So you take that away, and suddenly the profit disappears. The actual day-to-day business was still losing money. See how a headline number can tell a very different story from reality? And the red flags start to pile up from there. The company's actual revenue, still tiny. All those exciting fintech and AI plans, well, they're just plans, not actual money-making products yet. Plus, the company had a history of struggling to even stay listed on the NASDAQ. And maybe most important, that low float that caused the incredible spike, it's a double-edged sword. It can cause an equally fast and painful crash on the way down.
You know, one analyst really just hit the nail on the head. They said the stock was, quote, more of a speculative micro-cap lottery ticket than a stable growth investment. And that feels right, doesn't it? It's the thrill of a huge potential payoff, but with a very real risk that the ticket ends up being worthless.
So let's put all the pieces together. What really happened here? It's a three-step process. First, the reverse split created the perfect technical setup, that low-float tinderbox. Second, the compelling turnaround story provided the spark,
getting traders excited to buy. And third, you combined that speculative frenzy with a low supply of stock, and boom, you get a short-term, incredibly volatile price explosion.
And that really leaves us with the ultimate question, doesn't it? When you see a situation like this unfold, what are you really looking at? Is it a genuine once-in-a-lifetime high-growth opportunity, or is it just a high-risk gamble? In today's market, knowing the difference between the two, well, that's everything. Thanks for digging into this with me.